Hi, welcome to Academic Market Insights. My name is Dr. Russell Rhoads. I am a professor at the Kelley School of Business at Indiana University. I'm often joined by Dr. Ademiak, who's over at Purdue. Today, she's pretty hung up with first day of the semester type stuff, and I kind of wanted to get on this topic, so I'm going solo. As always, the part she's better at than I am. If you enjoyed this video, please hit the thumbs up. If you got comments or questions, use the section below. I like constructive criticism. And I like ideas about things to talk about. Today, I'm going to talk about private equity. And private equity is something I get a lot of questions about in the classroom. A lot of the graduate students doing Masters of MSF or Master of Science in Finance at Indiana really are interested in private equity. It's been a hot area lately. But this past weekend, and I sit here on August 25th, this past weekend, Barron's, the cover story, which made me cringe as I picked up the copy of Barron's at the end of my driveway and walked it up and saw that the cover was the $12 trillion opportunity, which is private equity for individuals. And there are some rule changes coming into play where private equity, like a lot of other higher end investment strategies that area is going to become more available to individuals. And it says the $12 trillion opportunity. That's how much is in 401ks. Probably not going to see the whole 12 trillion go into private equity, but there's some things within the article that I'd like to reemphasize that I think make an awful lot of sense, and just some things that people should have in the back of their minds if they're thinking about investing as an individual in private equity. Now, private equity, just to give everybody an overview of what it means, it's basically a direct investment in a private company. It's often done by firms that specialize in private equity, and they will also help management maybe find talent, might introduce them to suppliers, to new customers, help them with potential cost cutting. They will provide all kinds of help to startup firms, especially startup firms that maybe have never experienced rapid growth. One of the things with private equity, and often we think of new ways to invest, et cetera, as being very short-term focused or giving us short-term opportunities. And goodness knows when I talk to students, they all want to take advantage of short-term opportunities. I get questions about meme stocks, et cetera, on a regular basis, and I try to skirt those. With private equity, one of the things that you've got to keep in mind, and this is going to come back up in a few minutes, one of the things you have to keep in mind is the typical time frame is a decade plus. I've heard anywhere between 7 and 12 years thrown out there to realize returns from private equity. And that's because you are funding a private company that's going to go through a growth phase and often either be sold off to a competing firm, a bigger firm. Google has bought a lot of small technology firms if they have an interest in their tech, or they IPO it to the general public, and the early investors in private equity are able to monetize some or all of their investment when the company goes public. Now, there are different types of private equity. Venture capital is usually brought in at the early stage, and that's typically focusing on technology or maybe high-end biotech, things like that. And just the type of cutting edge science that can be monetized, or cutting edge ideas, or methods, services, etc. Anything that maybe could be a game changer within some sort of an industry would attract venture capital. Now, there are also firms that maybe are public that are not being run particularly well. And often one of these firms may be identified by a leveraged buyout firm. And what the leveraged buyout firm will do is they will issue debt and use that debt to purchase all of the shares. And the firm will be 100% financed by debt. If the leveraged buyout firm believes that, for lack of a better way to put it, they made 8% a year on the capital that they bring in to run the company, and the bonds cost them 6% a year, they're going to make money off of that spread. And I think that's where the word leverage comes from, because you're taking on pure debt. You've got to be able to pay that debt off. It's kind of a risky way to take over a company. However, it has been a highly profitable way to restructure companies. And often, firms that conduct leverage buyouts, after the firm is back on solid footing, they may IPO it again. So take it public again. And that's how they would go about monetizing that business. And then there can be lots of other special situations. We had somebody come to speak at one of my classes at Kelly about his venture capital or private equity firm. And I think private equity is a better title for it. They would take a look at firms in dying businesses and take a look at their assets. And instead of buying up all the equity of those firms, they would buy up all the debt of those firms. And if the assets had more value than the debt, or they could monetize those assets by utilizing them better than the company is, then that could end up being a profitable venture as well. And actually, what this firm did was there was a small regional newspaper that was going out of business. They had printing presses that they used 2 hours a day. They bought all their debt, took possession of the printing presses, and now they run them 24 hours a day and offer outsourced printing for magazines and newspapers, etc. So finding an asset that was being underutilized in a firm that was going out of business and found a way to monetize that. And that's a special situation that would fall under private equity. Now, the typical private equity investors right now, institutions with a very long time horizon, insurance companies, pension funds, endowments, for the type of entities that don't need to worry about having some of their capital tied up for a decade plus. Doesn't mean that insurance companies are going 100% in on private equity, but there are opportunities within private equity, and I'll actually show some performance history at the end as well to explain why that area might be attractive to institutions with a long time horizon. It's really to offset inflationary pressures. Businesses do tend to, and assets tend to grow a little more rapidly when we're in higher inflationary environments, and private equity would be a pretty good inflation hedge for these firms with longer time horizons. High net worth individuals, a lot of I grew up with someone whose father was heavily involved with a large corporation in the city that I grew up in, and that person's very well known. He cashed out of that company with a few $100 million and has backed some very recognizable technology companies out in California. So high net worth individuals, they may go through a private equity firm. They may actually start up their own private equity firm and use their expertise to help other companies grow and profit from that growth. And now for individuals, you can purchase shares in a private equity firm. There's been a lot of, there are about 2 or 3 private equity firms that you can get, or firms that are involved in private equity that you can get exposure to. But also through some rule changes, we're probably going to start seeing seeing more ETFs focusing on the strategy, and they're about to allow 401k money to go into private equity, which was part of the Barron's article. And the Barron's cover article is about private equity, as I mentioned. Made me pause for just a moment, but I really thought the article was well done. Just some things I like to highlight beyond it. And one of them is, current assets under management for private equity is around 3 trillion. 401k holdings in the US top 1.2 trillion. If 5% of that, well, if 1% of that money goes into private equity, that'd be 120 million more. So it really wouldn't move the needle that much on private equity. So even though it said 12 trillion, I would think maybe 5% at the most. But I think there are a lot of people with 401ks that it's not appropriate for them to be considering private equity. And that's where I really want to go. Some of my concerns, the article did note that the traditional institutional users of private equity have been shying away from this asset class lately. And one of the things that I like to teach my students is you want to be investing or doing things that the herd is not necessarily doing. If the herd of institutions is going in the opposite direction of something that you're thinking about investing in, you may want to pause there as well. Also, there's a lot of due diligence that's required when considering a private equity investment. This is one of those things that holds true for hedge funds as well. The type of investments that are at the higher end really should be more attractive to high net worth individuals as opposed to those of us working 9 to 5 and trying to save up for retirement. And then finally, this lack of liquidity in the space where you really are, you put money into a private equity fund and they invest in a first stage startup that's not going to go public for 7 to 10 years. That capital is going to be tied up. And if you are close to retirement, you don't want your capital tied up like that. It's this the private equity for individual investors, especially in a 401k, is really mostly appropriate for folks that have, I'd say, at least 20 years before they think they're going to retire. I'm closer than that, and I probably wouldn't consider private equity right now. The article mentions target date funds, and I think this is a great idea. Target date funds are the type of are ETFs that I'm in my late 50s. And if I'm planning on retiring at 70, I might have a target date fund that targets 2037. That's when I would turn 70. 2037, and it would have an appropriate mix of bonds and stocks based on my stage of life, etc. That's what target date funds work. That's how they work. I think private equity make an awful lot of sense in target date funds that have a longer time horizon as part of the equity exposure. And longer dated target date funds usually take on riskier stocks. And we often think of small cap stocks as being the riskier, but also with better returns. Small cap stocks, the returns for small cap stocks over the long term, they're a bit below large cap stocks now. That Fama French factor has fallen apart. And I believe if you go back to the last day of 1989 and you look at the Russell 2000 for small caps and the S&P 500 for large caps, a couple of years ago, the long-term performance for the S&P 500 topped that of the Russell 2000. So as opposed to putting small caps in a target date fund, maybe some target date funds should be thinking about private equity instead. Also, and I'm talking about target date funds that have at least 20 years until retirement, until that's the stage of life that the appropriate investors for those target date funds are at. Now, this is something that I found really interesting. And I got this from Cambridge Associates U.S. Private Equity Index and selected benchmark statistics. This is as of the end of the first quarter of 2025. And PE is the Cambridge Associates U.S. Private Equity Index performance. And it's, I believe it's, I hate to miscite numbers, but I believe it's somewhere between 1,500 and 2,000 funds that fill into that. And the year ending March 31st, 2025, the private equity index was up 7.41%. Small cap stocks were down. The Russell 2000 was down 3.99%. And then finally, the Russell 3000. And the Russell 3000 is the 3,000 of the largest equities listed in the United States. So that is not just large cap, that's 1,000 large cap stocks plus 2,000 small cap stocks. And you can see I've highlighted the best performance over every time period here. And I included the Russell 3000, but I'm really more fixated on the comparison with the Russell 2000. I wonder if private equity is the new small cap. And that's where maybe investors should be looking for extra returns only if they have the ability to take on extra risk. Otherwise, you're doing just fine investing in the general stock market. So with that one, I just really wanted to talk about that article. Barron's is my number one thing every Saturday morning, and I usually mark it up and take a look at a couple of the stock ideas, etc. But again, I get so many questions in the classroom about private equity that I really felt like I should put this video together and share it with the investment classes that I am teaching this quarter. We don't get into the equity part until about mid-October, but when we do, this is going to be one of the first things that I'm talking about in the classroom. So with that, I appreciate you sticking with me till the end. If you've got any comments or questions, feel free to use that email address. You can follow us on Twitter. You know where you are right now because there's that YouTube address. And we are in the process of building out our website. There's some white papers we've written that we're going to put up there, etc. So bookmark it, and we'll definitely give people a heads up when we've got that website up and running.